The obvious reading of the Canada-Germany LNG agreement is a diplomatic win for Prime Minister Carney. The more consequential reading is a repricing event for Lisims and every infrastructure name connected to it, and that second reading has not yet settled. Germany's state utility, SEFE, signed a 20-year, 1 million ton per year offtake agreement tied to the $10 billion Lisims floating terminal in northern British Columbia. Deliveries begin in the early 2030s. The deal is Canada's first LNG agreement with a European buyer, and Natural Resources Minister Hodgson framed it explicitly as a proof point that Canada can be trusted when Middle East supply is disrupted by the U.S.-Israel conflict with Iran. That geopolitical framing matters more than the volume itself. SEFE is not buying 1 million tons because the math on Pacific routing is obvious. It is buying because the alternative supply chains running through the Strait of Hormuz are now impaired for years, not weeks. For energy infrastructure positioning, the SEFE defitment does specific work. Lisims had regulatory approval, but no final investment decision. A 20-year offtake from a sovereign-backed German buyer changes the project's risk profile for lenders and equity sponsors. Offtake certainty is the most direct input into financing terms on a capital-intensive LNG terminal. The Globe and Mail's editorial framing, a rare triple win for Germany, Canada, and national unity, is worth noting not for its rhetoric, but for the signal it carries about the political durability of the project. Albertan gas flowing through BC infrastructure, federal backing, and Nisga'a Nation equity-heirship is structurally more insulated from policy reversal than pipeline projects without that Indigenous stake. BNN Bloomberg's infrastructure outlook described LNG growth as directly boosting Canadian energy infrastructure equities. Foreign net selling in Canadian energy had been concentrated in names without a clear export path outside North American gas benchmarks. The SEFE deal shifts that for LNG-linked infrastructure. The capital flow from domestic institutional buyers into Lisims project sponsors and connected pipeline names began on the announcement day, interpreted from price action on infrastructure names rather than reported net flow data. The upstream position pressure change is straightforward. Holders of Canadian energy infrastructure who were pricing a domestic-only demand profile must now price a multi-decade European offtake as a new fundamental variable. What the deal does not settle is whether the final investment decision actually follows. The Lisims partners have not yet committed to construction, and environmental opposition plus First Nations legal challenges from groups outside the Nisga'a Nation remain active. The SEFE commitment makes the FID more likely, it does not make it certain. That gap between more likely and confirmed is where the re-rating has stalled, and it is the same gap that Canada's second major announcement of the day began to address from a different direction.
The SAB Globalized selection is the mechanism-deepening chapter in Canada's sovereign capital reallocation story. It reveals that the LNG deal is not an isolated diplomatic gesture, but one node in a systematic pattern of state-directed capital moving out of U.S.-sourced supply chains. Carney announced at the CanSec military conference that Canada is entering exclusive negotiations with SAB to purchase the GlobalEye airborne early warning aircraft, bypassing two American competitors, Boeing's E-7 Wedgetail and L3 Harris's Ares X. The price tag is above $5 billion for 6 to 8 initial aircraft, with the government targeting 40 or more planes manufactured in Canada for export under SAB's partnership with Bombardier in Toronto. The political logic Carney articulated was unambiguous. Canada's dependency on American defense suppliers is a strategic liability, and the GlobalEye purchase is part of a $180 billion decade-long procurement strategy designed to create 125,000 domestic defense jobs. The capital flow that matters here is the institutional reallocation into CAE and Bombardier, the two Canadian firms with confirmed roles in the program. SAB's CEO told reporters that 6 to 8 GlobalEye aircraft would be fabricated largely at Bombardier's Toronto facility, and SAB signed a formal teaming agreement with CAE to deliver integrated training and simulation solutions for the Canadian Armed Forces. Both companies moved on the announcement. CAE had been carrying uncertainty about its U.S. defense exposure given the trade tension backdrop. The SAB partnership converts that uncertainty into a confirmed domestic revenue stream inside a $180 billion procurement envelope. The position pressure change for CAE holders is the transition from U.S. contract concentration risk to Canadian sovereign contract certainty. A holder reassessing CAE's forward revenue mix now has a structurally different denominator. The SAB pick also adds to the Lisims re-rating picture in one specific way. It demonstrates that the Carney government is willing to take procurement decisions that antagonize Washington on multiple fronts simultaneously, LNG exports to Germany and military aircraft from Sweden, within a single 24-hour window. That pattern signals the trade diversification framework is durable policy rather than selective posturing. The question left unresolved by the defense procurement story is whether the domestic financial sector is pricing this sovereign capital reallocation correctly, or whether its current earning speed is obscuring a structural vulnerability that the BOC's next rate decision could expose.
National Bank, BMO, and Scotiabank
all beat second quarter consensus estimates. The consensus reading is that Canadian banks are performing strongly. Jim Thorne of Wellington Altus Private Wealth offered the framing that matters more. Canadian banks may be over-earning, and the BOC risks compounding a policy mistake. National Bank's net income climbed 38% year-over-year to $1.2 billion, with adjusted earnings per share of $3.23 against a $3.13 forecast. BMO reported a 30% rise in quarterly profit and hiked its dividend. Scotiabank topped estimates despite rising impaired loans. The common thread across all three beats is the same: capital markets revenue running at a pace that analysts are treating as temporarily elevated rather than structurally sustainable. National Bank's own risk officer acknowledged that provisions for credit losses are expected to rise gradually through the year. The bank set aside $233 million in PCL, less than half of the $545 million a year earlier, partly because of a one-time accounting benefit from the Canadian Western Bank acquisition. Strip that out, and the credit quality picture is more ambiguous. The structural question Thorne named is the one that connects back to the day's sovereign reallocation story. If the BOC raises rates in response to geopolitical energy shocks in the Strait of Hormuz, the same supply disruption that drove Germany to sign the CFA deal, then the Canadian private sector absorbs a rate hike at a moment when full-time employment is already declining. The bank earnings beat would then represent the peak of a capital markets-driven cycle rather than a new baseline. Institutional positioning in Canadian bank equities appears to reflect the earnings beat without pricing the BOC risk premium. The spread between credit market signals and bank equity valuations has not yet closed, and it is the credit market that is pricing the BOC rate path more cautiously. Lululemon's 5% pop on the Chip Wilson truce is a one-session governance story with no bearing on the sovereign reallocation frame. Its resolution removes proxy overhang but leaves the brand's North American sales trajectory, down 9% per square foot in 2025, entirely unaddressed. The verification benchmark is the Bank of Canada's next rate decision. If the BOC holds and signals that geopolitical energy shocks are not sufficient justification for a domestic rate increase, the bank earnings re-rate higher and the sovereign capital allocation into energy and defense finds a supportive financial sector backdrop. The signal that breaks the thesis is not the next earnings print, it is whether Canadian bank credit spreads widen on BOC rate rhetoric before the next policy meeting, which would indicate that the participant structure in bank equity remains imbalanced even after the quarterly beat resolves. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.